Hello and welcome to Money Control. Well, the markets have been in correction mode since September. Some of the worries that we have been flagging, including a slowdown in earnings, overvaluation in small and mid caps, and the fact that there isn't yet a strong case for foreign investors to log into Indian equities, are all playing out as we speak. A 20% cut in mid-cap and small-cap indices has already happened, with energy, media and PSU stocks having corrected sharply over the past 6 months, although we have bounced back a little bit from the lows over the past two sessions. The only segments that have held steady are IT and private sector banks. Now, is the correction coming to an end, or is there more pain coming? I have with me a man who has been one of the best mid-cap fund managers over the past 20 years in India, Pankaj Tibrewal. Pankaj has a phenomenal track record of managing the Kotak Mid-Cap Fund for over 20 years with 20% plus returns annually. Now he manages his own investment management company called IKIGAI. So thank you so much for your time this morning, Pankaj. First things first, this is the first time since COVID that we have seen a 20% correction in small and mid caps across the board. Lots of sectors have lost a lot more. Media, for example, energy, metals, etc. have lost more than 20%, about 25% or so. Specific stocks have gone down even more. Some of them have corrected more than 50%. What is your take? What has caused this kind of weakness? Because we know that valuation in itself is not a driver of stock prices, either up or down. They can continue to be overvalued for a long time. They can continue to be undervalued for a long time. What is your sense in terms of what has triggered this big change?
Good morning, Mahalakshmi. If you remember, for the most part of last year, we were very concerned on the broader market space because of excesses which were created. And our view was that the economy was slowing down materially, led by various factors. First was the elections, then the extended monsoons, government capex not picking up. Actually, it was a decline till November of last year, and many other factors. Uh, Monetary policy was tight, liquidity was in deficit. Uh, my sense is that market is taking cognizance of that right now. And when you look at the June quarter results and September quarter results, the growth for NSE 500 companies on an average was just about 2 to 3%. So clearly valuations were sky high and data was not catching up in terms of earnings. And I think that is leading to market taking cognizance right now. And the large part of excesses post this correction across the broader market space has been removed. Going forward, however, post this correction, we are slightly turning more constructive than we have been in the last 12 months. And the reasons are as follows. First, after a long time, I think the central bank is coming into action, both on the monetary side as well as liquidity side. The system saw the highest deficit of 3 lakh crores, and that RBI has taken cognizance of. And various measures like open market operation, forex swap, and others are leading to liquidity turning into a neutral territory, which is a very good news for the entire banking system and economy as a whole. Second, after 5 years, RBI has started the rate cut cycle, which I think is a very, very good news because I think the higher interest rates, higher cost of capital was hurting private sector capex and consumption. So it's a welcome news. The second part is government, which was slow on spending. Until November, it was negative 12%. We saw that 1,70,000 crores getting spent in the month of December alone. And that negative 12% has turned into positive 1.8%. And in their own numbers, the revised estimate on the budget, if they want to meet the capex number, the Feb March quarter has to see 20% growth compounded for these 3 months, which means a very strong, sharp spending by the government. The third part is that the third quarter earnings season was far better than the first 2 quarters. And if I look at the NSE 500 companies' headline reported numbers, the reported earnings growth was about 8.5-9%, which in my view is far better than the first 2 quarters and better than our expectations. Though FY26 earnings estimates still need to be pruned, Market is expecting 15%. Our expectation is 11 to 12% earnings growth, which will happen probably in the course of the year. Uh, and last but not the least, all the economic data points which we are looking at since December, I think month on month we are seeing improvement, whether it be cement demand, whether it be long product steel demand, wires and cable demands, battery demand, in terms of GST collections, toll collections, electricity generation. All the high frequency data indicators are suggesting that the economy is coming back in shape. And also the Reserve Bank of India said that the fourth quarter GDP could be in tune of 6.6, 6.7% because the economic activity has started to pick up. And our sense is that the fourth quarter numbers
Right.
and the first quarter FY26 numbers will be far better than what we have seen in the first three quarters. So we are turning to be constructive. Many opportunities are now coming on the fore, and we believe that probably this will be the time to start accumulating for the next 2, 3 months as the market provides opportunity and stocks move from impatient investors to patient investors.
Lovely. So there are 5 points to talk about that you have laid out, Pankaj. So I want to definitely deep dive on, mapping the market in terms of how things have fallen and where do we go from here, segment by segment. But before that, just one question on sentiment. How is the Josh on the street from various constituencies? How do you see the retail investor responding to this? Are they getting scared and backing off? How is the cohort of high net worth individuals who are mostly your clients, how are they responding to it? Are they sort of prepared for lower returns from here on? Are they backing off? Are they moving to fixed income? Are they buying, stepping back to put in more money? So just tell us about the sentiment on the street.
So I have not seen a complete U-turn of sentiment like this in the last many, many years, right? 3 months back, if you said any concerns, you were labeled as conservative, a bear on the street. Today, when you talk about incremental changes being positive, which is government capex, budget, fiscal prudence, RBI acting, people are not willing to listen. So I think there's been a complete U-turn in terms of sentiment, and large part of the market is extremely bearish on the markets today, and prices are driving the narratives as we speak. However, we believe that there are value investors who are looking at this market, whom I regard in great respect. And my sense is that they are looking at markets very, very closely, and they think to be in the right space, that the market is providing opportunities. But always, Mahalakshmi, remember, we are in Kumbh, period right now. Market is a Triveni Sangam of three things: uh, fundamentals, valuation, and flows and sentiment. And these three things combined lead to what the market is. Incrementally, my sense is fundamentals have started to improve compared to what we saw in the last year. Flows, domestics have still been buyers, but I think FI flows have to stop to market to get a direction. I don't have an answer when it will happen because the noise is too large in terms of Trump, in terms of China, in terms of money flowing to US and China, both out of emerging markets. So I don't have an answer when the FIs resume their buying in India, but valuations on dollar terms is becoming very attractive. Market is down by 20 to 23% in dollar terms from the peak. So that should help FIs from a valuations perspective. And don't forget that China has outperformed India year to date by 20% in dollar terms, MSCI India, and in last year by 37%. So clearly that trade of China versus India has played out beautifully. And asset allocators globally who were looking India from more of a structural angle, it's a great time. But I don't know when that will resume. Either the dollar index has to come very sharply lower to revive the risk on appetite back into emerging markets, including India, or something else. So I don't have an answer. And sentiment, as we discussed, has been extremely poor right now. Markets are completely bearish because 3 out of 4 investors in the last 5 years have not seen a bear market or a correction like this. This is the first time in last 45 days
Right.
you saw 20% plus very fast correction. So that has taken everybody by surprise, and a lot of investors probably are completely shattered. If you ask me, the small retail investors, the leveraged borrowers, I think that's something which is probably leading me to the fact that the final capitulation leg is still not happened. Maybe in the next 2 3 months, the final capitulation leg will happen. That will form the bottom of the markets beautifully. But what we have started to advise client is use the next few months to start investing and accumulating gradually on the time which we all were waiting for. The overall story of India has not changed what it was 6 months back. The story remains to be positive. It's the intermediate correction which happened every year except 4 years out of the 44 calendar years in the market. We have seen 10 to 15% correction. That's part and parcel of the equity markets.
So, Pankaj, what you're saying is that the best in terms of discretionary money coming into markets, and especially from say high net worth individuals, which has also been a big driving force for our markets, that has seen its peak, but the final capitulation has not happened. You're saying it will take 2 3 months for that to happen, which means more pain, isn't it?
No, Mahalakshmi, I think HNIs, many of them were sitting on cash since because last year valuations have been prohibitive. So I believe that a lot of them probably are looking at it in a constructive way in terms of opportunity for the next 2 3 or 4 years.
Okay.
And many stocks, if you remove the noise today,
Okay.
have started offering decent opportunities. So I think that cohort of the market, probably which is more well educated, more are looking for opportunities from a longer term. I think they are looking at constructively. But the retail part of the market, which
Okay.
probably was the driving force, I think they are a bit unnerved by this correction. Let's see how they behave as they move ahead. SIP flows continue to be strong in January. We have to watch out for the Feb numbers also. I think at 25, 26,000 crore of SIP flow, it's very, very encouraging. And if we continue to educate people that SIP is the right way to go for the next 3 4 5 years to achieve your goal, I think there should not be any big stoppage or slowdown as the SIP flow is concerned. So domestic should be okay. But the trader community, the people who wanted quick money and they were making quick money for the last 3 4 years, I think that segment probably will take a backseat for some more time because they have seen a huge brunt in terms of their wealth in the last 45 days.
Okay. And when you say that the final leg of final capitulation is yet to happen, what does that mean in terms of price correction?
So in terms of price correction, I think the worst we have seen is except the GFC and the COVID period, where small caps have corrected by 35, 40, 45%. But on a general, a 30% correction is a very, very good correction at the index level. That means at the stock level, individual level,
Right.
it could be far in excess of that. We are already 23, 24% down on the small
Right.
cap index. Maybe 5, 6% here and there at the index level should form the final capitulation as far markets are concerned. But I have started to see value after a long time. And if one takes a 3 year view, there are many good quality companies after a long time which are available at your pace of valuations. Is it become mouth watering? Answer is no. But is it time to start accumulating because only God and liars know where is the top and where is the bottom in the market? So I believe that this probably I am not capable of predicting that, but I believe that next couple of months, whenever market provides this opportunity, should be used to increase your equity allocation from a risk perspective.
Sure. So one more question on something that is in news, Trump tariff, and there has been a lot of noise around that. First, around the metal stocks because of steel, aluminium tariffs, and then there is some conversation around 25% tariff on automobiles, semiconductors, and pharmaceuticals, and textile stocks have fallen. So out of all this, just tell us, is there anything that you found remarkable that changes the investment case for stocks or sectors?
So, Mahalakshmi, I think there's a lot of noise relating to tariffs. When I look at an aggregate basis first, India, in terms of trading partner and trade deficit, we are only 4% of the net imports in US. There are countries bigger than us in terms of trading partners with US, China, Mexico, Ireland to that extent, Taiwan, Cambodia. So all these countries are bigger than us in terms of trading partners. So yes, uh, knowing this person, he is a complete negotiator. He will negotiate hard in terms of various things and put pressure. You saw that after the visit, there has been a LinkedIn post by Tesla that they have been starting to thinking about opening office, and it's a recruitment of 13 people.
Right.
So I believe that over the course of next 45, 50 days, I think he will negotiate hard with countries like India as well, that please take my energy, please take my defense, in order we will do something for you. And I think this will be a bigger negotiation tactic. Look at what concern is there on pharma. I mean, you would accept the fact that India is the pharmacy to the world, and we are a core player to supply generic drugs to US, and we have lowered the healthcare cost for US. If you put a 25-30% tariff, it's not the companies will suffer out there. It's the normal citizen of US where the care cost goes up. And in my view, it will be good news for Indian pharma companies. I am a contrarian on this side that for a long time, Indian companies were not able to raise prices. And this will give them an opportunity to raise prices also. And many companies on the auto banks and other are cost plus conversion models, which means that any incremental cost will be passed on to the client out there in US, and they work on a cost plus margin. And if there is a dollar appreciation, depreciation, they pass on the benefits or the hit. And also, if there is a tariff, I think they will pass it on. So my sense is lot of noise is there in terms of reciprocal tariffs and others. But on an aggregate basis, if I look at over the next 3 years, will it impact ability of Indian exporters to, from an export perspective out there in US? My answer will be clearly no. I think, on the contrary, I believe we will be the biggest beneficiaries because this geopolitical tussle between US and China in terms of power will give companies in India great opportunities to explore. And as we speak, I was speaking to two, three companies yesterday, and they are leaders in the sector in India and Middle East, and they are looking to explore US as a market in terms of setting up operations out there. So I believe that Indians probably are the best placed, if you ask me, in this tariff noise, and that we will come to decipher after 5, 6 months.
Okay. So going back to what you started off with, you said that, you're constructive, and in some pockets you don't see mouth-watering valuations, but you do see some value emerging. So tell us about the segments that you are most bullish on, or where you see there is considerable value emerging.
So I think, Mahalakshmi, we have to see where are the pockets of excesses created over the last 3, 4 years. And what happened in April 20 was that there was a big style shift which took place from growth quality to value. And that lasted for almost 4, 4.5 years. And that I think that has started to turn around. And I think there's a one big style change that growth quality and low volatility as a style should do better than momentum, beta, and other styles and value, which has worked for the last 4.5 years. And I think you should take cognizance of this because if you don't structure your portfolio according to the styles which probably will be there, I think portfolios could suffer. And you saw that in the last cycle, you were holding good quality companies, but growth didn't come in, and value as a proposition, high beta as a proposition, momentum as a proposition did extremely well. So that's a one style change which is happening. Second, I think from a excesses perspective, many sectors like power, defense, railways, infra, and capital goods to a large extent saw valuation re-rating significantly more than the earnings growth. And there was the entire narrative about the capex-led growth of India because government tripled its capex over the last 3.5, 4 years. I think that is now normalizing, and government has clearly shown that the next few years will be for the welfare of the people. And I think consumption, which had taken a backseat, I believe that over the next 2.5 years, consumption, mainly discretionary spend, should start coming back again. And that's one segment. Probably you could see shift happening from a large part of industrials to consumer discretionary. That is one sector. The second sector is banking and NBFC, especially the private sector. They have been laggards over the last 4, 5 years. And I see early signs. And in this fall also, if you look at Mahalakshmi, the private sector banks and NBFC have not actually corrected since January onwards. And there seems to be some kind of money shifting happening from high beta sectors to banking, which can deliver predictably 15, 18% earnings growth. That's the second sector. The other 3, 4 sectors are cement, uh, where I think in this fall also they are standing tall, and incremental changes are positive in terms of both pricing and volume growth. The other sector is metals. I believe that probably metals is at the worst phase in terms of pricing, both in ferrous and non-ferrous. And incrementally, you have started to see pricing uptick on the metal side, and it's a tactical opportunity. The other sector where I believe there is decent amount of opportunity brewing up is specialty chemicals. You need to be a stock picker there. But I think that sector, again, for the last 3.5, 4 years, went through its own challenges. I think the destocking phase on agri globally is coming to an end, and the restocking will probably start now. And valuations and time corrections have happened. So I believe that sector, from a bottom up perspective, is offering another opportunity. And last but not the least is energy. And when you combine all these sectors together, the total profit contribution to the profitability pool is about 55 to 60%. And their market cap contribution, because they have not really worked over the last 2, 3, 4 years, is about 40%. So I think there is a big gap between profit contribution to market cap contribution. And I think that should reverse as you move ahead over the next 2, 3 years. The leaders of the segment, obviously, market will change. It will be men versus boys. The macro trade is behind us. Now is the time for micro trade. It will be a stock pickers market for the next 18, 24 months. Not everything will move up, and we need to be very cognizant of this fact that bottom up stock picking, which has not been rewarded, it was all boards being uplifted because of the tide. I think that environment is going to be changed as we speak in the next 18, 24 months. So we need to be extremely bottom up in terms of our approach on stock picking.
Right. So, Pankaj, specifically on consumer, I mean, especially after the budget, there has been a lot of conversation around, consumption stocks, especially most people believe that consumer discretionaries and durables will do well. Consumer staples is still, low growth, at least the listed players, and the valuations are considerably higher, and therefore that might just a flat line. But there is a lot of optimism around durables and discretionary. How do you see valuation here? Because there are specific stocks like Zomato. I mean, it's quite a motley bunch. You have something like Zomato, which has gone up so much, all the digital stocks in play. And then you have something like a Whirlpool, the durables play, Voltas, and so on. Where do you really see value in all of this?
Yeah. So I think our sense is on the discretionary side.
While the demand case, while it is easier to make a case around demand uptick in these segments, it doesn't look like the valuation really is comfortable, or do you disagree?
So Mahalakshmi, always at the bottom of the cycle of a demand, headline valuations will never look to be attractive, because analysts are always scared about penciling a growth number because their projections for the last few years have not gone correct. And hence, they are always conservative in extrapolating the top line growth and the operating leverage which can kick in. Our sense is that with money flowing in the bottom of the pyramid, the middle of the pyramid of India, and the rural segment starting to do well, our preferences will be for the low ticket durable items. Our preference will be for retailing apparel, which is doing well. And look at one part from an overall India perspective, that the aspiration of India, the young India, is far higher than the disposable income in their hands. What does it mean? That companies who can offer aspirational products at an affordable pricing, I think will be the winners in the next cycle. And clearly, you are seeing that Judios has solved that problem from 500 to 1000 rupee kind of a range bucket. They are offering aspirational products at a very affordable pricing. There's a new company, which probably one should keep in mind, a company called Snitch. I think it's doing all the right things, all the right parameters are ticked in that. And that company is solving the problem between 1000 to 2000 rupees ticket size. Very premium looking products at a right affordable pricing. So I think companies which can cater to that aspirational India at a affordable pricing will be our bets, whether it will be in retailing, whether it be in the footwear, whether it be in the durable space. I think there's a large segment on discretionary side which is waiting for that. Above that, I think experiences have become a very large portion of discretionary spend in terms of airlines, hotel travel, tourism. I think all these will take also a part of our portfolio in terms of discretionary spend. But over the next 3, 4 years, I think the indication by the government is very clear that yes, we needed to pump up the economy through infra spend. We have done that with the 30% CAGR over the last 4, 5 years. Now, I think it's about the welfare of the people to increase the demand pie of the economy, and they're trying to do that. And last 3, 4 months kind of indication suggests that over the next 2, 3 years, consumption discretionary should make a comeback as a sector, and bottom-up stock picking in that should also be carefully avoided.
Fair enough. I think one thing you didn't talk about is real estate. I mean, what is your take? Actually, two, real estate and autos. How do you see these two sectors? Because these could also be beneficiaries of, a spending uptick.
So, real estate, I think we are in a mid cycle. We are definitely not in early cycle or late cycle. And I think next cycle, this cycle could last for another few years, in my view, because the inventory side is still at reasonable levels. By the top 8, 10 cities we track, the inventory levels have not gone up very, very high. So, our sense is that real estate probably should do reasonably okay, but be mindful of the fact that a lot of demand at the higher end of the real estate was also fueled by the stock market. And if stock market is range bound, consolidating, people are not making too much of money the way they were in the last 3, 4 years, the higher end of real estate probably could be under pressure. But the middle bracket, where there's a large part of demand, and that has got sidelined because in the last 2 year prices went very significantly higher. I think that part, if it is offered at a reasonable value, I think could see buyers. So I'm not very concerned on the middle pie, but the top end could see some slowdown, which has been the driving force for real estate for the last few years, mainly because of the stock market wealth creation being lower. The other part is the auto side. I think we are seeing mixed bag in auto. Last year, two-wheelers did extremely well. And I believe that that momentum continues because of the rural recovery being better than what we thought about at the start of the year. But anything to do with urban is seeing some kind of a stress. And in PV, I think there's a lot of disruption happening, a lot of confusion in the minds of customers, that whether they should buy a ICE engine, whether they should buy a EV, what is the infrastructure they should be deploying. And I think PV seems to be in a low single digit, 4, 5% growth area. Tractor seems to be doing well. Two-wheeler seems to be doing well. There's an uptick starting to happen in MHCV. Our indication, speaking to financiers and OEs both, suggest that January was good and February is also seeing an uptick on the CV demand. So I think it's a mixed bag in auto. You can't have the same thought process across all the segments of an auto. Rural doing well, two-wheelers doing well, cars are having a slightly rough patch, MHCV starting to pick up from a very, very bad base of last year.
Sure. And one last question, Pankaj, on insurance stocks, because these stocks have sort of gone down. I mean, many of them maybe have gone up a little bit now, but nearly at the same level as 5 years ago, because there has been so much bad news in terms of regulatory upheaval in this sector. How do you see this space? Because it seems like some institutional buying also is happening in these stocks.
So our sense is that the segment is quite reasonably valued now, and I think you should see a decent traction in this segment coming along. Uh, our sense is it's a decent place to be in as you move forward. So having a positive view across this segment as well.
Thank you so much. That's all we have time for, Pankaj. Thank you so much for joining me this morning.
Thank you. It's been a pleasure speaking to you again today.